Laricy Project. This is a show about all things real estate, business, marketing, and entrepreneurship. Each show consists of myself, Matt Laricy, a member of my team, and a guest. This week, the Matt Laricy Group team member joining us is none other than Joe Rueck. Joe, how we doing today?
Doing all right.
All right.
Good.
Good. That's good. Now, for those of you guys that don't know, I actually know Joe from my wife's youngest sister, Lauren. He's been dating her for, how long have you been with Lauren now?
Just over 9 years.
9 years. And I've been married to my wife now for 4, and I've been with her for a little bit. And I've known Joe since I've been dating and now married to Nicole. And Joe is actually engaged, finally, to Lauren. I've actually been telling people you've been engaged to Lauren probably for about 5 years. And how long ago did you get engaged?
Maybe about a month ago.
About a month ago. Okay. And you're going to be getting married next July what's...
That's the plan.
That's the plan. Okay. So, Joe, how long have you been with the Matt Laricy Group for?
Just over 3 years.
Just over 3 years. And you got your degree in finance, is that correct?
That's incorrect. No, I got my degree in accounting.
Accounting. Same difference in my opinion. So, and kind of talking about the accounting and knowing that he's got such a background in finance and things of that nature. This week, episode 3 is called The Rise of Rates. So we brought in none other than Fifth Third's number 1 lender in the world, right? Is that the world?
That's true.
That's the world. Tony Lupescu with Fifth Third. Now, I've been working with Tony. How long have I been working with you, Tony?
I think your whole career.
Since I got in the business in 2006. And Tony's a fellow PP, which is a Palos Parker. Grew up in the same neighborhood together. Tony, tell us a little bit about yourself.
Basically, I started my professional career as a CPA doing accounting, auditing, and taxes. And then I transitioned over to the mortgage business almost 14 years ago. Okay. And have you always been working at Fifth Third? Have you been with a lot of different companies in the past? I've been with actually 4 total companies. And I've been with Fifth Third for the last 7 years. Okay. What made you want to get into the mortgage business? Well, actually, it was my best friend was very successful in it, and he was recruiting me for many years. And it was just something that he told me I'd be really good at, and to give it a shot. I always liked sales, so it was something that I took a chance on. Nice. Now, one of the things that we're really interested in here and want your opinion on is that there's this big talk about the rise in interest rates. It's something that everybody's talking about. Do you think this rise in rates is something to worry about? Well, I think it's something that's coming. I mean, I don't know if you want to say to worry about, but it's something if you're looking to purchase, I would say definitely rates are going to be higher in the future than they are today. Now, like a lot of people are talking, maybe this rise of rates is really going to affect the market in a negative way. Do you feel that's something that's going to happen? Is it going to have a negative impact on the market? Well, it could. It just depends on how the economy is going overall. But sometimes if interest rates go up, it could put some pressure on prices. But we haven't really seen that, even though the rates have gone up, probably 0.5% in the last year or so, or more. I've been seeing like a lot of my own clients are getting a little bit hesitant and a little bit more nervous because they keep saying, well, the rates are going up. Joe, do you see that a lot? Because you work with a lot of younger first-time buyers. Do you see a lot of people complaining about the rates to you lately?
Yeah, I feel like I have a lot of clients who are kind of in a rush now just because the fear of higher interest rates. They think, I don't know where they hear it from, either their parents or whatnot, that rates are on the rise. You better get in somewhere quick and get that rate locked in now rather than later. Do you think it's legit that people should be worrying about these rates, Tony? Well, I think that they should be aware that rates will be going up. Based on several different factors. So the long-term outlook is that rates are going to be higher. So if you're looking to buy and you want to get lower monthly payments, it should be something that you're looking at sooner than later. Now, one of the big things I hear a lot is like the rising rates. We're at an all-time high for an economy. Unemployment's at a low. We're heading towards this recession, and people think we're about to see this huge crash. If I have to hear one more time that we're in a housing bubble and the market's headed for doomsday. Do you see this? Do you see any sense of a big recession coming? The only thing that I would say, is one of the things in terms of potential recession that is out there is that the yield curve. So basically what that means
What is it? What the hell is a yield curve?
So basically what that means is...
Joe, you hear about this before?
A little bit.
A little bit, okay.
What that is the difference between long-term rates and short-term rates. So, like for example, a short-term rate would be a 7-year ARM, which is an adjustable rate mortgage where your rate's locked in for 7 years versus a 30-year fix where your rate's locked in for 30 years. So the difference is that what they call the yield curve, or the difference, the percentage difference between the 7-year ARM and the 30-year fixed has been tightening as of late. So like it might only be a quarter to a half point difference between those rates than it used to be, where the spread used to be, or the difference used to be 1.5%.
So what does that mean for regular Joe out there that doesn't even understand what a yield curve is?
So basically what that means is historically when the yield curve has been inverted, or what that means is when short-term rates have caught up to or been higher than long-term rates, it can signal a recession is coming within the next 12 months. But that hasn't happened yet. So
do you anticipate that to happen?
It's just something you have to watch. I would say that unless that happens, it's really not something you have to be concerned about right now until that actually happens.
Do you think that if we do hit a recession, do you foresee it being more of a 2008 recession, or do you see it being kind of like a normal recession that because America is a capitalist country, so we go through highs and lows. You can't always be at a high. At a certain point, the market's got to come down a little bit. And Chicago, on average, UBS actually just named Chicago as the least likely city in the country to see some sort of bubble, and obviously we sell real estate over here. Do you see the recession having like a huge impact, or is it going to have maybe some sort of small impact on the market? I
don't think you're going to see the kind of recession or that you saw back in 2008 to 2010 or 11. The reason is I think a big part of that was caused by the way that the lending was done. So basically, anybody could get a loan at the time.
No money down loans, right?
No money down loans, no income verification. So the difference is back then, anybody can get a loan. Right now,
just like a heartbeat,
pretty much. Sometimes I don't think you even needed that.
Okay.
So the difference is now is that everything is being checked, the income's being checked, so people are a lot more qualified. So that bubble isn't going to happen like it happened in the past.
Got it. Now, Joe, you weren't around in the recession. So where were you in 2008? Were you in college? High school?
Yeah, I was going into my freshman year.
Okay. So he wasn't around. Now, I was selling real estate in 2006. Tony, you were obviously giving loans out then. How did the recession, did it have a huge impact on your business?
Well, it definitely did in regards on the purchase business, because people were afraid to buy at the time because prices kept going down. The one thing is when there is a recession, a lot of times the interest rates will then go down. So there was a lot of refinancing being done at the time.
So in essence, you don't really think it'll have, let's say we have a small recession and the interest rates go up a little bit. Do you see it having like a huge impact on the real estate market at all? Like what are you doing? What are you planning? Like how do you feel about this?
Well, I think that in terms of getting, I think about planning for the future, and let's say if there's a recession, I think that you just have to see how it goes. I'm not planning for anything big or it to change things drastically.
So like if let's say, because the rates right now are about, what's the current rate? I mean, today, October 3rd, 2018, rate today is what, 4.8-ish?
No, they're around, like a conventional 30-year fix is around 4.5, 4.625, and 4.5 to 4.75, depending on credit, loan to value.
And a year ago today, roughly?
It was about 0.5% lower.
Okay, and what does a half point do to a buyer's payment? Like, what would that average out to? Like $100, $400?
Well, it depends. Let's say you had a loan amount of, let's say, $350,000.
Okay.
A half point would cost you about a little bit over $100 a month.
Okay, so
it would basically equate to like maybe a $25,000 difference in purchasing power.
Okay, and do you see like a lot of your clients that because you are taking these loan applications firsthand, do you see a lot of your people are complaining about that extra half point than when their friends bought a year ago?
Well, it's actually interesting. It depends the demographic. A lot of my clients that are in their 20s or early 30s, when they hear that the interest rates are where they're at now, think it's really high. I took a loan yesterday from somebody that's 70 years old, and when I told him that the rates were in the 4s, he said, "I just still can't believe they're so low." So it depends. It depends on the age group.
What's the average? If you had to put like an average, over the history of America, what's the average rate you think it was? Because I know when my parents first bought their place, interest rates were 16 to 18%. So it's like putting a house on a credit card.
Right.
Today, like you said, a 7-year-old guy, these seem super low. What's an average American history? Do you know?
About 7.5% to 8%.
Joe, do you think your clients would be cool with an 8% interest rate?
I don't think they would be going for that. No.
So Joe works mostly with first-time and younger buyers. I mean, he's a younger guy, which is good, and that's what we're seeing a lot of clientele because there is a huge population of first-time buyers coming in here. I think millennials are going to overtake as the highest population to buy real estate in the next couple of years. So I do think these interest rates and all the talk on it is going to have like a big effect on it. Kind of talking about interest rates and things like that.
Well, I want to cut you off there. I wanted to ask. So how would you, when you have a client that comes to you, how do you kind of explain when they ask the question, well, is it better to buy now or, should I wait? How much is like, I'm scared the interest rates are going to go up. I don't really know what to do.
Well, I think that if they're going to be buying a place and they know interest rates are going up, if it's something that you can lock in now and secure the payment and you're comfortable with it and you're going to be in the place for a while, I think it's always best to move forward because if we think that rates are going to be going up, you're only going to pay more for that property. And if pricing goes up even, average 3 to 5% a year, then you're going to be paying more for the property and more to borrow that money.
I know that I was always told that what's underpriced today or overpriced today is underpriced tomorrow. So with prices continuing to head up and interest rates continuing to head up, I mean, there's no leverage to sit around and wait. And I think the problem is that a lot of younger buyers, they only know two types of housing economy. They know the worst market of all time, doomsday, 2008, and they know the best market of all time, which has been the last couple of years. But there's something that I believe that's in between, which is a normal market. Things aren't supposed to sell in 24 to 48 hours. Not everything has where 1 billion buyers and an all-time low inventory and things sell in 24 hours or less. And I think, Joe, you could probably attest to this. A lot of people are probably not used to this. And we're in a shift. I think we're in the start of a shift. Do you think you're seeing a lot of your buyers that are getting approved kind of scared about that type of shift, Tony?
Not really. I mean, it just seems like most people that are interested and want to buy a property are buying and they want to get in before rates get higher.
So do you consider rates still low in your opinion?
Absolutely.
Okay. What about like adjustable rate mortgages? Because you hear a lot of stuff about fixed rates, adjustable rates, 30 years, 15 years. Like, is there any difference with an adjustable rate right now compared to a fixed rate? Are those still lower?
Well, as I was saying before about the yield curve, the difference between the adjustable rates and the long-term fixed rates are getting tighter, so there's not as much of a difference. I would tell you that I think it depends what you're using the property for. So sometimes people say, well, I want a 30-year fixed loan, and they're buying their first place in the city, and they're 30 years old because their parents told them to get a 30-year fixed loan. Well, if their intention is only to live there for, let's say, 3 to 7 years, you might as well take a shorter-term loan and pay less interest over time if you're not going to hold on to the property.
So somebody that's in their 20-something, 30-somethings, buying a first place, 3 to 7 years, what would you say, like what's the product that you mostly say this makes the most sense for you to buy or to purchase?
Yeah, I usually ask them what their intention is when they move out. So what I mean by that is if they are going to keep the property long term and use it as a rental property when they moved out, then I would definitely recommend a 30-year fixed. But if it was something that they were going to live there again for 3 to 5 years, and then they know they're going to move, they never want to be a landlord, they're going to move out of Chicago or wherever they're at, I would recommend an ARM at that point.
So do you think fixed or adjustables are better? Do you have like an opinion on what you prefer?
Again, it just depends on the circumstance, but I would say right now I'm doing less adjustables just because there's not as much of a difference in the rates from the fixed to the adjustable as there was in the past.
What's the average that people are putting down today compared to in the past, and like what would you recommend? Because I know like a lot of, like we were talking about back in the day, you were getting away, well, in the boom days, people were getting away with no money down. I'm starting to see a lot 5% down. Like, what's the average? Like, you're telling people like you should prepare to plan to put down X amount.
Yeah, it just depends on their situation. I would say that some people want to put down 20% or 25%, and they want to keep their payments at a certain level.
What's the benefit of putting down a 20 or 25%?
So if you put down at least 20%, you're not paying mortgage insurance or PMI, called private mortgage insurance.
What's PMI called?
So basically, it's private mortgage insurance. So
Okay.
what it is it's insurance for the bank that you're not going to default on your loan. So you used to have to put down at least 20%, and then these private mortgage insurance companies came in and allowed people to buy with less than 20%
So
down.
we could think of PMI as kind of like extra juice that you have to pay because you're a higher risk. Is that kind of a way to look at it?
I would say yes.
Okay.
But the one thing, going back to your other question before, a lot of times people say, well, I want to wait till I have 20% down because I don't want to pay the PMI. The problem with that is that the PMI, if your credit score is really good, is very cheap. Even if your credit score is okay, it's not that expensive anymore. So people that, let's say, in January of this year said, well, I'm going to wait till the winter or next year to buy so I can put 20% down. That PMI might have only been less than 0.5% added onto their interest rate, where now they're putting the 20% down and they're still basically paying the same or more because interest rates went up. Whereas when you have 20% equity and you're paying off the loan, the PMI actually falls off once you get to 80%.
But you could put down 10% today, and then you eventually get up to 20%, and the PMI goes away, right?
Exactly.
So you could get rid of the juice if you save later on. So may as well buy now and not have to worry about the juice.
And that's basically what I was trying to say is that what people are doing is that if let's say you have whatever the interest rates are today, and you're adding 1/4 to 0.5% in mortgage insurance. What happens is that's going to fall off eventually, but if you wait another 6 months to buy and rates are a 0.5 point higher, your rates are never going to go down.
Right.
At that point.
Joe, you work with a lot of first-time buyers. How much percent down are you seeing your clients kind of put down?
I would say on average between 5 and 10%.
Yeah.
Now, a question I have for Tony is I had a client who was recently bought a place, and he was only putting down 5%, but I don't know what it was or if it was a certain program that his lender had. He was able to get his PMI pretty much wiped clean. He swears that he does not have to pay any PMI. Can you elaborate on this?
Are there programs out there for that?
There's things that are called lender paid MI, or you can pay basically where they can add it to the interest rate, and basically what they're doing is just increasing your interest rate so you're not paying a monthly mortgage insurance, or you can pay a fee up front to buy it out.
So it's just kind of like extra fees to try to waive some fees down the line or something like that.
Correct.
Now, what about closing costs? You see a lot of people, I'm starting to see people ask for closing costs a little bit more often in the last couple of months than I have in the past. As a lender, do you think closing costs are a good idea? Because I have people who actually have the means to put 20% down and don't need to ask for closing costs, but they think it's a good idea because rates are low and they want to leverage their cash. Thoughts?
Well, that's exactly right. So, I mean, I see a lot of people that have the funds to do it, and if they talk to their financial planner or they're savvy about it, it's something that a lot of times they want to put the least amount out of their pocket to get the best rate and the best deal. So they'd rather finance that money, let's say at 4.5%, and go invest it somewhere else.
Got it.
To make more.
Got it. Now, what about no money down? We were talking about that briefly. Do you think that's ever going to come back again? I mean, I've actually heard some rumors that they're going to bring back the dreaded no money down loans. Is that possible? Do you think it's going to happen? And I don't mean to like maybe a grant to like veterans or things like that. I'm talking about like the regular guy off the street. Are they going to be able to find a no money down loan?
I don't think that's going to. I don't think that's going to come anytime soon. There's a lot of programs out there for first-time home buyers for the average person to put 3% down. There are other like specialty programs like veterans programs that allow no money down, or like physician programs that allow no money down.
Right.
But for the average buyer, I would say probably 3% down is going to be the minimum.
Okay, and what about lender fees? I always hear there's different things with lender fees. They're all over the board. Everybody's got different things. How are some lenders able to waive fees? It's a question I get all the time. Like, hey, my lender was able to waive fees. Is your guy able to do that? What does that even mean?
Well, typically, I would say there's a cost always of doing the loan and processing the loan. So
right.
what happens is that I'd say a typical cost is probably somewhere between $1,000 and $1,500 would be an average lender fee. Now, a lot of times, some people, it's just the way that they'll market it, say, well, maybe I don't have any fees, but then maybe they're not giving them the best interest rate. So really what you want to do is look at the combination of both the fees and the interest rate and make sure you're getting the best deal long term.
So they bump down the fees so it looks pretty, but they're actually charging them points or an extra percent or something like that.
Correct.
So you're paying for it somewhere.
Correct. Sometimes I have people that say, oh, I'm getting this interest rate, and I know it's a way below market interest rate that doesn't exist. Then I ask them if they're paying, well, are you paying any points or fees, which basically a point is a percentage of the loan amount. And they'll say, oh, yeah, well, they're charging me $10,000. Well, that's really not comparing apples to apples.
So there's no such thing as a free lunch, I guess.
That's right.
What can people say about like what they can expect their closing costs to be? Because they're all over the board. A lot of people are like, what's the percentage I can expect? Is there like a certain dollar amount that you could say is definitely average?
Well, it depends where you're purchasing.
Okay.
So are you saying like Chicago?
Let's say Chicago. We're in Chicago. What do we have to expect here?
So if you had, let's say, a $400,000 purchase price, you're probably looking at right around $8,000. I would say, and part of it is because you have your lender fees, your appraisal fees, your attorney fees, your title fees, and your City of Chicago transfer tax.
We have a Crook County fee to pay into the city because we are told there's some crooks around. But so take Chicago out of it. $8,000 for Chicago. General nationwide, then would it be around like 5 or 6?
About $5,000. So in that example, I gave a $400,000 purchase price. City of Chicago charges 0.75% in a transfer tax, so that'd be $3,000.
So what about like getting people's budgets? Like I know, Joe, like you'll have a lot of clients that make maybe $100,000. Like what can I expect I can afford? We may have a guy that makes $500,000. Like what do you tell somebody to like plan that they can afford it? If they make X amount, they can buy X. Is it like a percentage of their income, or what do you generally tell those people?
Well, the calculation to qualify them is a percentage of their income, but usually what I tell people is if they're first-time home buyers and their question is, well, how much can I afford? I usually ask them the question back, how much do you want to pay on a monthly basis? Because you might be able to afford, in terms of qualifying, a lot more than you want to pay every month. And then sometimes what people don't want to do is, let's say, buy their first place in Chicago or move to Chicago, get this great place, and then never be able to go out.
Like living paycheck to paycheck.
Exactly, or not have enough funds to go out and have dinner or do the things that you want to do in Chicago.
But so what percentage? What do we got? Like what are we working with? 20%, 10%, 15% of their income? What would you say?
So typically people can spend up to about 45% of their total gross income.
Okay, now are you
in total debts?
Are you seeing more because the economy's good? People are spending. Are you seeing more people live paycheck to paycheck to afford a nicer place? I mean, with the Instagram and Facebook society, they want to kind of impress their friends more with the pictures they got. Are you seeing that more often?
I would say no. I think people are trying to live within their means.
Okay.
And most of the time when I ask people what they want to spend, they give me a number, and then we work backwards and say, well, this is what that would look like or what you can afford.
Yeah, and I would think most people like my age, especially my clients and friends of mine, we were still young, but we saw most of our parents and families like going through that, that
hardship?
2008. Yeah, and I feel like a lot of people are scared. Like, okay, well, I might not want to bite off more than I could chew.
Yeah. So people are still a little bit, wary to get in the housing market because we've all kind of been punched in the face a little bit and seen like what happens with the market. What about on savings account? Like I keep reading in different articles that, the average person under the age of 35 has less than $1,000 in their bank account, but yet I'm seeing people buy places left and right. I mean, do you see that true at all?
Well, it just depends. We see a lot of clients that have savings and are financially stable that are buying properties most of the time.
Now, what about like when it comes to like refinancing? That's been like a big thing because again, a lot of people, as you said, about 7.5 is American, like kind of like average, and I'm sure a lot of people who do have these 30-year loans. And now that rates are kind of creeping up a little bit, is refinancing even worth it, or are the days of refinancing gone?
Well, it just depends what happens in the market. I'd say right now you're not seeing a lot of refinances at all. The only thing that we're probably going to see a lot more of is people that took adjustable rate mortgages, that their rates are going to be going up, so they're going to want to refinance.
What does like refinancing? What does it even mean? Like how do you go about that process? Is it just like kind of like reapplying for a loan? Is that basically it? You're just trying to get a lower rate?
That's basically what it is. You're just restructuring the terms of your loan to get a lower rate or lower payment or lock in longer terms.
Is there a lot of costs involved? Do lenders usually do that for free?
It just depends. I mean, you're probably looking anywhere like I would say up to around $2,500 usually is the most like in cost. It's a lot cheaper than doing a purchase. You don't have to pay the city of Chicago again.
Why would you would you refinance if you only plan on living there for like 2 or 3 years, or is this only like if you're going to be like 10 years plus at the place?
It would be just if there's enough cost savings. So if let's say rates went down 0.5% and you have a $400,000 loan, that would mean you'd save $2,000 of interest a year. So if it costs you $2,000 to do the refinance and you're going to be there 3 years, you'd net $4,000 savings. So then it would make sense.
Got it. Now, what about all we hear now is after the doomsday scenario, the bust of the market, that getting a loan is a nightmare. And I hear about this all the time. Some of my buyers really complain. Some of them you never hear from. Why is it that there's this big perception right now that getting a loan is such a nightmare?
Well, of that...
Joe agrees. See? He has troubles.
So part of the reason goes back to one of the things that we started off the conversation about is that do we think we'll see another market with a huge bust or a huge recession? Right. So back sometimes if people bought their first place back in 2005, 6, 7, they didn't have to give any paperwork, any income, any asset documentation, and based on their credit, they were getting loans.
So just a driver's license and a heartbeat optional, right?
Pretty much.
Okay.
So now the difference is we have to verify everything. So we have to verify your income, your assets, to make sure that you can qualify for the loan.
Is there certain clients, like let's say like a certain profession that's harder? Is it self-employed people with like regular 9-to-5 jobs? Like what makes it harder to get a loan? Like why do some people bitch more than others?
Well, I think part of it has to do with who they're working with as a lender, because if you set all the expectations right up front and say
this is a plug for Tony Lupescu, by the way.
it's not, but actually it's true that in terms of if you're working with a lender that knows what they're doing, they should be able to set the right expectations up front and let the buyers know what they're going to need to do. So if the problem is a lot of people aren't told what they need, and so the lenders just keep coming back and ask them for things over and over and over again.
Now, Joe struggles with getting loans for his own properties. Now, Joe owns a lot of investment properties. Is it because he's self-employed? Joe, what do you think is wrong with you to get these loans?
Well, the thing is I wasn't around to see how it used to be. But all I know is, Tony and their whole team are sending me emails and text, for weeks. Hey, we need this, we need this, we need that. Asking for my college transcripts and stuff. So it gets pretty detailed.
Could also be that Joe's not that organized. I don't know. Is there what about a rate for an investment? Because like we're talking, like Joe owns some investment properties, I own investment properties, but I know that you got a bunch of them as well. Is there different rate? Like if you're an investor, do you have a different rates compared to like a normal loan? What does that even mean?
Yeah, so basically the government buys Fannie Mae and Freddie Mac. The government runs those entities which buy all the mortgages. And so what happens is that for investment properties, there's more of a risk than an owner-occupied loan.
Why? Why would that be?
Because investors default more than an owner-occupied loan would.
Is there like a stat on like how many? And I'm just curious. Like is there like 20% more investors default than regular people?
They have everything based off actuarial numbers. So there's just difference with credit scores, investment versus owner-occupied. So there's all different statistics, and they just put their pricing together accordingly.
Do you see more people are trying to buy investment properties? Because the stock market is, as we know, is an all-time high. What's going to happen? I can't predict it. But do you see a lot of people maybe trying to invest more in real estate and get more investment loans? Are you seeing a spike of that in your own business?
Yeah, I think a lot of people are interested in the real estate investment. They've seen whether it's been their family or friends or other people that have been successful doing it. So there is definitely a lot of interest, especially going back to what you said with the stock market. There's some people that have made money there and I've seen pull money out to invest in real estate.
Right. I know, I personally am seeing more and more stuff, and we're big on social media and seeing a lot of people posting hey, I got my 10th investment property, or I'm starting to see kind of flips get back in the market. Remember the whole rich dad, poor dad thing way back in the day, and we're seeing that a little bit more. And kind of going off of social media, do you feel like social media is changing the lending industry at all? Are you seeing that happen at all in your personal business or in the business in general?
I think it is, just because of just the awareness and people seeing others out there and that kind of thing.
How are some lenders? Because I noticed it seems like smaller banks have bigger presence on social media, and then bigger banks like Chase and Fifth Third like yourself, but compared to these other one-off companies, are there more restrictions against big banks, or how's that work?
I would say that there are more restrictions. You're monitored a little bit more on what you can post and things that you can put out there.
Are you using personally, like, we love using Instagram and Facebook and stuff like that, and obviously video in our business. And, are you trying to get more involved in that for your own personal business?
Yeah, trying to get more involved, I would say, with doing more with Facebook, LinkedIn, that kind of thing, to promote my business and just keep in touch with the past clients that I've worked with over the years.
Awesome. Now, what about, like, kind of speaking about online presences, one of the big things I'm kind of seeing more is a lot of these online banks. Quicken Loans is one that comes to my mind. I feel like we're seeing a lot of pre-approvals come in from Quicken. I know, Joe, even like a lot of your clients will send over approvals from Quicken. What do you think? Like, why do you think they're kind of growing in popularity?
I think just maybe because a lot of younger clients are used to doing things online, which...
Like the instant gratification society.
Exactly, and Amazon, so everything shows up at your door the next day when you order
click of
it.
the button. Yep.
So when you're getting financing, it's a different story, and that's why you don't really see any. I don't know any real estate agents that refer people to Quicken Loans or any online sources. Usually because they want to make sure that things close and you don't have any problems and stuff like that. So I would tell you that for a refinance transaction, they probably could get it done if it's something that you have a lot of time and you don't have to worry about. But it's something that on a purchase, especially with talk about, let's say in Chicago, you have to get the condo approved, you have to know what you're looking at, and a lot of times they have no idea where to even start because they're in a call center in Cleveland or Detroit.
So just basically because like they're not as local. What if Quicken starts opening up a bunch of local branches? Do you think that would affect the loan market at all?
I would say only if most buyers work with somebody that their realtor recommends or a friend or family recommends. So
Sure.
Unless that really starts changing, I don't really see it impacting it too much.
So we're seeing like a big presence of like online real estate companies. They're called virtual brokers. A lot of that stuff is taken over. I mean, Redfin is a big company that's been taking up a large share. A lot of people like it because you a little bit of rebate, and it's affected some realtors. It hasn't affected some, and they've announced that they're getting into the mortgage industry. Do you see that affecting the mortgage? One, like your personal business, and two, like do you see it affecting like changing like guidelines at all?
I don't think we'll have to see what happens and how they run their platform. But I think part of it is, again, going back to the real estate agents. You're probably not going to refer somebody to Redfin in terms of
be a competitor. Yeah,
exactly. So I think on that side of it, I don't know exactly what they're going to offer or how it's going to look, but I think that that's a little bit of a barrier to entry.
I think probably the only thing that we definitely, well, not the only thing, but a big thing that we have problems with a lot of the online lenders, because we do come across them often, is that the closing costs, they have a really big trouble and struggle of like explaining them, and we've had a lot of instances where deals fall apart because at the end they get explained that there's all these extra costs, like in Chicago again, we have Crook County fees, so we have to pay these fees, and people don't know about them. But anyways, we have what we call the Fast Five, okay, which are 5 questions we ask each guest, and our co-hosts ask each questions. Joe, you got these ready to go here?
I'm ready.
All right, let's start with number 1.
All right. Which is worse to regret, making a mistake or not trying at all?
I would say not trying at all for sure. If you don't try something, you don't know if it's going to work. So I always say give something a shot, and I'd rather try something than not do it at all.
Okay.
Do you love to win or do you hate to lose?
My favorite question here.
Well, I would say professionally, it would be hate to lose. I'd say I expect good results from myself, so I would expect to win a lot of times. So I would say I take that more for granted, and if I don't, I take that more to heart.
That's a good answer.
I mean, it's the right answer. I mean, the corporate people say that you're only supposed to love to win, But I personally disagree. But we're told that we're wrong for that.
What is your favorite quote and why?
That's a good question. I would say one of them that I like a lot is if you're going through hell, keep going. And I heard that attributed to Winston Churchill. And I just think that's a a good way to be, because sometimes when people are down or something bad happens, they dwell on it, and all it does is take up your time. You're not productive. So I always, if something's bothering me, I just try to keep my head down and keep working hard, push through it.
Keep getting through it, yeah.
If you retired tomorrow and wanted to start a wildly different second career, what would you do?
I've always liked to race cars. So if I was going to do something completely different, racing cars would be a lot of fun.
You kind of look just like Jeff Gordon as well. I was kind of thinking the same. Or what was that one guy, Kyle Busch? NASCAR 500. Okay, all right.
Ricky Bobby.
Yeah, Ricky Bobby. If you're not first, you're last. I thought it was going to be his favorite quote too.
All right, last question here. What makes you Chicago?
I would say the hard work ethic. I think Chicago's known for its hard work ethic, its hustle, and again, going back to what I was saying, keeping your head down and working hard. And I would say that my clients know that I'm always available. I work hard all the time, and it's just something that is ingrained in me.
It's that Midwest mentality. So, Tony, where can people find you, and what do you want to plug?
So. Again, I'm with Fifth Third Bank. I'll probably ask you to put some of my information on the show notes there.
Okay,
so
Fifth Third.
So people can get my information, but you can find me online on Twitter, LinkedIn, Facebook.
And is it just at Tony Lupescu? Do you have a website or anything like that you want to plug? Is it at TonyLupescu.com or anything?
I have a website through Fifth Third Bank that I have to use. So if you Google my name, you'll see it right at the top.
Perfect. So thanks for coming today. Make sure to tune into our next episode and subscribe to our podcast. Follow us on Facebook and Instagram. Thanks for listening to the Matt Laricy Project, and we'll see you next week.